Ladies and gentlemen, it has come that time in which we will have our strategy meeting. This is where our trading team comes together and we have a discussion about what some of the key themes will be. And it's a big one because we've just started a brand new year, and therefore we should have some pretty big ideas on deck for what might shape up 2020 for us. And so therefore, I want to lead off with a macro perspective, and we're going to bring in Brett Manning, aka Chart Trader, to the discussion because he always gives us a nice overview of what he's seeing, and we'll just start the conversation there. So Brett, we've had no shortage of macro-related geopolitical items going on. What is your overall take? We haven't heard from you on this, at least in the audio landscape, for a while, so what's your take? Where are we?
Oh, hey, Jim. So I think that obviously the new situation with Iran is a major factor, and it has everybody's eyeballs right now. But I think that you really have to divide the situation into two parts. So this Iran situation and sort of the stage that it's walked out onto. And the stage that it's walked out onto is something I've been kind of framing as sort of a bullish perfect storm of contextual factors. Not necessarily performance factors, but the context is like a bullish perfect storm. So I want to describe what I mean by that. So for the first time ever, right now, we have the Fed expanding its balance sheet at the same time as the ECB and the BOJ. We have basically joint fiscal and monetary easing going on simultaneously pretty much everywhere around the world. We've just taken off the worst case scenarios in terms of Brexit and the U.S.-China trade war. At least that's the narrative that the market's running with, and at least for an intermediate term time frame, probably through the election. And at the same time, the unemployment rate in the United States, the United Kingdom, Germany, and Japan are all at all-time lows, while we see no signs of inflation. So if you mix into that factor the fact that the Fed has also basically promised that it's pledged essentially that it will let inflation overshoot if that's possible before tightening policy. So that's really kind of unprecedented too, and it comes from being in this context where, you know, we're so inured to this low inflation situation, this, you know, where central banks really are getting a pat on the back if they can get inflation up. And that's an odd situation historically. So the upshot of that is the Fed has now finally reached the point where they're basically saying, you know, even if we see great economic data going forward, we're not going to hike. That's not going to be the hike signal. The hike signal will be when we have an actual inflation problem, and it's actually here, not theoretically here. So that context, with all of that other good stuff going on, that context really is a big picture, macro, policy-based, huge upside potential, and we're seeing the market react to that. But the other big factor is what I call the comps argument. So the comps argument really goes back to late 2017 when we had the tax reform bill, and we've had this kind of oscillation effect from this. So the tax reform bill is a huge fiscal stimulus. It was $2 trillion fiscal stimulus, and its window of greatest impact was really in Q3 of 2018. Right, so 2 years ago from this coming September and August, basically. So the upshot of that is that this past year, in 2019, when we got to that same period of the year, we were facing really tough year-over-year comps because we were comparing back to the window of second derivative impact of a $2 trillion fiscal stimulus. So it was really tough on year-over-year. So we saw an earnings recession. We saw a lot of difficult economic data. July, August, September of 2019. And that was also when we kind of had the flame up of the U.S.-China trade war. That's when things seemed the worst. So both were at the same time. So, of course, we had a huge jump in recession expectations and a massive dive in long-term interest rates, and the yield curve inverted. So all those things were operative at the same time, but it wasn't necessarily that we were at a typical kind of cycle end point. It's just we had this confluence of factors that sort of simulated that feeling to things. And interestingly, this was also when we had some of the biggest amount of corporate paper roll over at the same time. So it just, you know, serendipity that interest rates were at all-time lows when a lot of major Fortune 500 companies were rolling over corporate debt, and corporate debt has really been the fuel for this whole business cycle, rather than, obviously share creation. We've seen share elimination in the stock market throughout the entire cycle. You don't see the stock splits, you don't see the secondary offerings, because everything is on the debt side because interest rates have been so low. So that fuels the next leg, right? So, but then this folds over into this oscillation of what we have ahead of us now is great comps, like really easy comps. So 2020, what the market is discounting into right now is that you have the opposite end of that. All that stuff, if we take the U.S.-China flame up sort of off the table, Brexit flame up sort of off the table, and now we don't have as difficult a comps. We actually have easy comps for economically, for earnings, everything. So we're running into Q2 and Q3 of easy comps. So we should see it'd be much easier to see year-over-year growth and all sorts of stuff this year, and I think the market's reacting to that. And again, all that comes in the context of basically the Fed saying, even if the data's great, great data gets to be great for the market now if it happens. So the only thing we're waiting for now is that we see actual positive performance, because we haven't seen that yet. So if we see something like leading indicators start to genuinely pick up, PMIs, we're still kind of slogging along, and we haven't seen that jump to where this whole breakout is really justified. So, but that's the context, and I think of it like a contextual bullish perfect storm. We just need, the actual performance of everything to kind of justify what the market is doing, but the context is a really easy one for everything to be really good. So that's the stage, and that's what Iran is hitting in right now. And so you see this, I think, extraordinary level of complacency. And I posted this morning in my notes, what I think is the most interesting way to look at it is you've got this geopolitical threat that looks really intense, and some people are saying maybe the most intense in terms of militarily for a couple decades. And the equity hedging index that I posted this morning in my notes, it's at 2-year lows. So people aren't hedged coming into this, and yet they're still not getting on the offer in the indexes, which I think is really interesting, and it shows just how unwilling people are to miss out on that bullish perfect storm context.
All right, Brett. So with that said, timing this is going to be very tricky. What it sounds like to me is that you expect some type of maybe panic hedging at some point, and that would be the buying opportunity.
Hopefully, and I'm not saying hopefully there'll be a military reprisal, but strictly from a market strategy standpoint, you would want to see something tip money managers who are unhedged into hedging sharply into something that's probably not going to be a cycle-defining factor. So, in other words, it's got opportunity written all over it if the market does panic on it. But we've got so much of an unwillingness to miss out on this context. And the other factor that really kind of folds into this, something that Gavin and I covered, and I'm sure Gavin, remembers, as we've kind of focused on this in our Sentiment and Flow show. You go back a few months, you're looking at a context where people were, historic level underexposed to the stock market on a cyclical basis. When you talk about the money that's cycle in, cycle out, and that's gauging the cycle, not the fixed weight guys, but you've got, sort of long-only equity onlys and hedge funds and mom and pops and everything like that was really historically underexposed to the market. And then you blossom into this bullish perfect storm context. So it's been a migration back in, and the momentum of that psychological shift is just going in, is roaring right now. And you almost get the feeling that this market is like, if somebody were to drop a nuke on the exchange, the market would rally the next day. Like, that's kind of where we are on a sentiment basis right now. Now, the question is, have we overshot in terms of exposure? And I think we're on the way there, but I'm not so sure that we've gotten there. And the other thing that you can get in a situation like this is positive feedback. In other words, the sentiment becomes so good that it bleeds over into the real economy. It bleeds over into the way people are acting because the stock market's doing so great. Banks start to lend a bit more. People start to hire a bit more. It can have a little bit of a sort of George Soros style feedback in the context. So you can then get the justification by the data sort of as a part of that process. But, I don't know if we do see some kind of military reprisal, we do see some kind of manifest retaliation, I have to assume that the hedges will come in, and that's when you get the opportunity, probably both on the short side and then the long side, if you're talking about equities.
Yeah, I think one of the things that we should probably keep in mind is based on the fact that if we are underhedged, based on what you're seeing and reading through, that it may not even take a large military response. It could be a lot of talk, and that could get hedges going, and we may see a day or two where the market comes in quite a bit, and you can see a big buildup of hedging, but nothing really happens. The market's very fragile in that regard, I still seem to think, and that might be the best type of scenario. That way,
you mean preemptive hedging?
Yes, exactly.
Well,
preemptive hedging without
where
any.
Is that? But that's what I thought yesterday when I came in and started trading.
Yeah, I know,
but
what?
Well, it wasn't there.
I think that the rhetoric will pick up. I think there'll be a lot more tough talk. Maybe if there's not necessarily a response, I don't think the Iranian people will sit still for things just being idle. There's going to have to be some type of talk, and I think that I'm just giving you an analysis of maybe what might be the best case scenario, so that there isn't a huge military fallout.
Right.
It's just how fragile we are, and because we're underhedged, that may inspire people to get hedged, and then again, a best case scenario where we could see a dip that is then viable. Just a lot of tough talk.
Absolutely. You were talking about my trading plan when I entered the day yesterday. It was, we have the bounty put out on Trump's head over the weekend. We have the attack in Kenya. We have, and now this morning we had 13 different retaliation scenarios outlined by Iran that they actually put out publicly, and so they're watching like 19 different faces closely, like somebody driving slowly in front of your house, and throwing a brick through your window with a note saying you're screwed on it. That's kind of, right now they're doing a lot of that sort of stuff, and I think the market is kind of starting to get the idea that, well, it's just going to be talk from Iran, because they don't want, they need to, I think that there's a regime situation in Iran. They want to maintain control, and so they need to look like they're not going to let this pass. But I think a lot of it is really like, well, do they really want to pick a fight? Or do they want to make sure that the people at home see that they're willing to be tough in the face of the situation? But taking that next step and having it become something manifest, I feel like the market is willing to take a lot of trash talk in stride. But you would need to see something tangible to start to bring those hedges in. I think that's what we saw yesterday is the sign that that's the game plan. Is we're not going to go ahead and because hedging is this is competitive. Right, you are competing against a benchmark that's roaring, and if you hedge and the market doesn't flinch, then you lose ground. And in a late 1990s style bull market, that's deadly to a fund manager, especially long only, equity only. Mm-hmm. So they're going to be very hesitant to not be full throttle unless they're definitely going to take pain for it. And so I think there's kind of this situation when the news hit, when the Soleimani news hit, we had a pause of 15, 30 minutes before the market started dropping. And I think part of it was kind of like people sitting there going, oh God, this is a problem, maybe bid a little into gold, maybe bid a little into yen, but I don't want to sit here and selling equity futures until I see somebody else start doing it. I think that was kind of, and then once it started happening, then it happened. Mm-hmm. And we lost, 100, 150 points in the NASDAQ. But it took 15 minutes before we started seeing anything, or even more, and it just rolled into action. It was something like a slow momentum, and I feel like that's the sign of a market where people really don't want to lose full exposure, and they're really going to wait to see to make sure that, okay, is everybody else selling? Okay, fine, then I'm going to start selling. And it needed to kind of pick up that momentum. So I feel like at this point, given the proof points we've had over the last couple of days, you're not going to see an equity downside reaction to this unless or until we see a manifest military response. That's my base case now. It was not yesterday when I entered. I thought unquestionably we'd see those hedges come in, and we didn't. So I'm kind of thinking in terms of, well, I'm going to be more apt to be on the long side and play on the long side or avoid the short side until I see that there's, that ball starts to roll a bit. But I am long gold, and I think that people are hedging that way too. They're long yen, they're long gold. Gold is outperforming oil on this, which is another interesting sign. It's basically saying, maybe there won't be anything, but I need to have exposure to gold. So there's that version of hedging.
Yeah, and it sounds like with gold, you also kind of have that win-win situation based on positioning. So if there is something that goes down, you're already hedged with a long gold position, but you didn't have any indication that you were going to take off your long gold position because you wanted to be long it regardless.
Yeah.
Regardless, so it's not just
exactly
a hedge.
Right.
It's convenient. Just convenient hedge.
Yeah, no, it really. I was not. It's not like a few weeks ago I said to myself, I think we might take out this Soleimani guy, so I'm going to buy some gold. I mean, it was completely independent of this. So this is just, this is just what it is. This is sometimes you get lucky in a position.
Yeah, and so far it's working out. As far as targets that you may have in this GLD, have you outlined those?
I have not, and people have asked me, and I've basically said I can't tell you what that is because I need to see how the move evolves. This would be the third major upward leg in a new bull market, as far as I see it, in gold. That really got its traction back when we first started talking about this position. You probably remember way back in August of 2018. I put on a position right at the lows, and I got shaken out of it. But it was that big ascending triangle in its D leg before it really took off to the upside. That was the new bull market. That's where its seeds were. It was in that sell-off in gold. You saw the miners just get crushed during that period. That was the bottom of a kind of sideways bear market period. But this is a new bull market in gold, and this is that next leg up. And, it's going to be really interesting to see where it goes because we have remember the theme behind the reason why I originally wanted to buy gold and why I did then rebuy it last year in early in May, I believe, or late April. Mm-hmm. And we had a huge position, a big breakout, got doubled up with GLD and the futures and made a ton over the summer on that big ascending triangle breakout. But the reasoning behind it was really about the fact that whenever we have cyclical problems, we get to a point where we need to basically reinvent monetary policy, and that's a tremendous variable to have out there. And there's going to be a lot of demand to allocate to gold just because we don't understand what the next paradigm horizon is in monetary policy, because the old system is clearly not going to sustain us through whatever the next downturn looks like. So I think that there's a kind of sustained bid there that's probably going to be relatively supportive in gold for quite some time.
All right, I'm going to bring event trader Gavin McGuire into the discussion. And Gavin, I know the turmoil in the Middle East has stolen the headlines, but let's not forget there's still some other things going on potentially in Europe. We've got different elections, but also the Brexit that's still out there. And I almost forgot we still have this ongoing impeachment hearing. So that's again, I almost forgot that was going on because of all the turmoil going on in Iran. So why don't you get us up to speed? What's the risk associated with Brexit and any of the other macro events that we haven't discussed yet?
Yeah, well, I mean, we talked a lot about Iran here. Excuse me. And that's obviously going to be at the forefront of everything, but really what it's going to build into is that this is an election year and how that's going to play out. And not just here in the U.S., but I think a big one that's probably getting overlooked is Israel has elections in March, too. And when you're looking at the Iran situation, this all plays into, right now you have a market that's looking for some sort of retaliation from Iran as one of the top stories. But the question is whether or not Iran wants to do anything ahead of the elections, kind of giving President Trump a little bit more to build off of in terms of getting support from his base. And then you got Israel, too, which, they don't want to see a hawkish Israeli prime minister come in, so that could lead to Iran not really jumping back at the U.S. right off the bat. And I think that's one of the things that the market's taken into consideration. We didn't really see too much of a gyration around when the Saudi oil fields were hit. And, we're not seeing a big movement and reaction here. So whether or not, it's tough to figure out how big of a story this is going to be. And because I think, again, the main thing's going to be that election year, and that's what a lot of people are going to be focusing on. And it's going to take a little while to figure out who's going to be getting on the Democratic side of this ticket here. So there's going to be some uncertainty going in, and possibly all the way to the Democratic convention. When you talk to Carmine, it's not out of the question that we won't know who's going to be going up against Trump. And until we get that, I think we're kind of in a steady narrative that Brett was just describing here. Now, a lot of it's going to come around economic data and the earnings data, which we'll get into in a little bit. But for me, I continue to point to everything being based around this election. Now, when you talk about Brexit, I don't think anybody really has an idea of how to really put a finger on what kind of impact that would have on the markets. One feels like they've been properly positioned for Brexit, so I'm not looking for Brexit to have a big impact on things. Certainly, oil and how that plays out with the Strait of Hormuz around Iran will be a big factor going forward on the macro front. And really the biggest factor in that's going to be, how does that work its way down to the consumer spending, and does that start driving up inflation prices? And that leads me to what I think is the biggest story going on for 2020, and that's going to be inflation. And, we talked a little bit there about oil and the idea that could get jacked up on supply coming off the base here. But there's another interesting item on this, too, on the inflation front, where technology has been viewed as one of the biggest reasons for why inflation hasn't run away. And there was an interesting read in Barron's a couple of days ago talking about the Ubers and Lyfts of the world, and all these companies that have been running real low prices for serving the consumer, and yet they're not making any money. And we saw with WeWork that investors are going to have a lot bigger focus on these companies making money. So does that start working its way into its pricing strategy, which starts driving up prices for investors there as well? And then you also have, in the backdrop to that investor piece, which Brett had just mentioned, was a lot of countries moving more towards fiscal stimulus. And fiscal stimulus obviously creates increased demand, and that could, again, drive inflation. So I think watching inflation and inflationary plays is going to remain one of the key items that we're going to need to keep an eye out on going into the 2020 year. One of the things that I'm looking in at purchasing right now is TIPS ETF, which is, hold on, I had it right in front of me there, which is TIP was the best one that I was seeing. And this is going to be basically a hedge that I'll be looking at. Hold on, Brett's got an interjection here, but just TIP, which is the iShares TIPS bond ETF that I'm looking at as a nice swing play going into 2020. Brett, what you got on you?
Oh, I just wanted to say, one thing that I was talking about maybe a week ago or so in my notes is just right in line with what Gavin is saying. So everything that I said about this bullish perfect storm context gets completely unraveled if inflation suddenly becomes a boogeyman again. I talk about the two boogeymen. One, when deflation is the boogeyman, people act a certain way. When inflation is the boogeyman, people act a certain way. And history is just full of the process of swinging from seeing one as the boogeyman to seeing the other as the boogeyman. And at some point, right now, deflation is the clear boogeyman. And at some point, inflation will become the boogeyman again. If that happens this year, it completely destroys that bullish perfect storm. That is the one arrow, that is the Achilles heel for this whole thing. So, yeah, if that's correct, that inflation is going to outperform expectations, then it truly is the big boogeyman for the market this year.
Right, and then just the other thing I'd throw out on that inflation trade potential is a weaker dollar, which I think a lot of people are viewing the dollar as being overbought. Maybe not as much as it was a couple of months ago, but that's just one more factor working its way into this inflation front. So for me, I think that's kind of the big story that we need to pay attention to on the macro side, because as Brett said, everything else is kind of set up for that rally, and I think in the early part of the year that will remain the case. But as we start getting more towards the middle, and valuations are going to be extremely outpriced at that point, and if you start seeing any signs of inflation coming in, I think it's wise just to have a small part of your portfolio based in some inflation hedging protections, like a gold, like Brett has, that tip trade that I was just talking about, and we'll some of the miners could also play in, copper as well, of course. So there's some areas that I think you want to have a little bit of exposure until we get some further as we start moving into the year, especially if things start rising and we start seeing some of these inflation stories that I was just talking about. Higher oil prices, higher pricing from the Ubers of the world and things like that. That's when you're really going to start wondering to see if that consumer can maintain the strength in the recent context that we've seen in.
All right. So I'm going to bring in blue chip trader now, Scott Smith. And Scott, I know with earnings season on the horizon, you are setting things up because your activity level does pick up quite a bit. We haven't even talked about earnings season. I think it starts with the financials next week. And again, your activity level does pick up quite a bit when we do have the earnings releases. We talk about your different strategies, the gap strategy that you have, disruptive gap. However, before we get into that, because I know you're not a fundamental guy, you wait for technicals and price action and whatnot, but what sectors are you seeing that might be advantageous now? Where are some breakouts, maybe some under the radar themes that you might see in as far as a sector perspective goes?
All right, let me put my Dow 30,000 hat on before I start talking. Yeah, so in case you didn't notice, that's only about 4% away on the Dow to get up to that high. So I don't think that that's out of the possibilities of seeing sometime throughout 2020. I know we have a ton of concerns out there, geopolitical, election years, everything else that's going on that Gavin and Brett just highlighted for us. But this market continues to climb a huge wall of worry, and it's just been doing it for 10 years now. It's in the middle of a secular bull cycle. The market is banging on all cylinders in all time frames, and more importantly, it's almost all asset classes. You're seeing almost, I think the term is a Goldilocks economy going on here, and everything is just on the rise here. Now, granted, there's a ton of noise in and out on a daily basis and weekly basis, but that's just natural ebb and flow that happens throughout a strong bull market. And I've said this before, that sector rotation is often considered to be the lifeblood of a bull market, and I think that is just the key thing that you have to focus in here. Again, for 2020, it's just going to be a matter of relative strength and relative weakness, and identifying the leaders and the laggards, and then just jumping on board those names for opportunities. And that's the key thing going on here. So as we start off a new year here, a lot of the trends that carried over from Q4 of 2019 are still in effect here. So your leading sectors are really going to just stick with technology, healthcare, financials, industrials, and then bringing up the rear, believe it or not, is energy. And we've talked about this a couple times throughout the last couple months. Energy is probably one of the most under-owned and under-loved sectors over the last year and a half or so. And I do think that, unfortunately, with the recent geopolitical turmoil, we do have these rises in crude oil as of late, and I do think that money is going to be rotating back into some of these energy names here. I've been kind of advocating that you slowly wade into this over the last quarter or so. But for the most part, technology is still leading to the upside, and healthcare. So that's basically a good chunk of the NASDAQ market there. And if anybody's been around for more than 20, 25 years, you know that when the NASDAQ is leading the way into higher ground, it's very difficult to be betting against the economy and the growth that is happening all around there. So add in the fact that behind technology and healthcare, we have financials also showing a pretty strong performance as of late. And then, as I said, industrials are doing pretty well there. I'm a little hesitant on transportation. I'd like to see them breaking out. If you take a look at the IYT chart, it has been struggling with some resistance all throughout 2019. But at the same time, it's looking pretty constructive. And I think if transportation actually starts breaking out above, say, year-and-a-half highs, that if on a chart of IYT, that would be the 200 mark. If it starts busting out above that, you're going to have the whole Dow theory in play there, where you have transportations basically moving higher with manufacturers, and you're just going to be banging on all cylinders again to the upside here. And that's just another piece of the puzzle here, which is why I remain a pretty strong bull. Now, short term, there's a lot of signs that this market definitely needs some sort of rest. Just based upon how extended it is from its 50-day moving averages, its 20-day moving averages, RSI readings, technical indicators. But the problem with overbought markets, especially in this type of environment, is everybody knows that it's overbought. And when everybody knows that it's overbought, it's really, really difficult to bet against that. And those little dips are going to get, bought up quickly like we saw yesterday and reverse things back to the upside. And the rotations are going to continue to kick in. And I think there's just plenty of more opportunities trading-wise early on here into 2020 that you just got to be cautious. I'm a cautious bull because things are a little extended in the near term, but bigger picture, things are just looking fantastic.
All right. And are there any particular names that you're eyeballing that I know you're not a fundamental guy, but from a technical perspective, is energy kind of your focus to kind of nibble at for maybe a little bit longer term swing trades than what you normally have?
Yeah, I would even put that energy in more of the investment category as opposed to swing trading, just because they are so beaten down, and a lot of them, obviously, with price action going down, dividend yields have gone higher. And, I was advocating a couple of those oil services names picking up there in Q4, like Schlumberger, SLB, Halliburton was a good one back in October and November, as they all started to break long-term downtrends and start turning to the upside there. And I'm still a pretty big fan of those. I was pretty bullish on Oxy as well. I know they're going through some sort of merger with who is it? Apache, right? Or Endarco? I was confused. No, APC, I believe.
Oh, APC, I'm sorry.
Yeah, so Apache. But yeah, so it's just that's another just a solid company that's been around forever, and you could just look at that chart. You see, it lagged for certain going into the year end, but now it seems to be on the mend here. So another nice name there. If you want to talk individual names, and this is a name that I really haven't seen too much of us talk about at all during Q4 because we were kind of all focused on the leadership moving higher there. But General Electric actually looks really good on a long-term chart. Finally, this stock. I know it's got its issues over the last years. Let's just say years. But 2019 was kind of this basing consolidation year for the stock, and it started to perk up there in Q4, and it's actually started off the year pretty strong here, getting closer, actually probing the $12 mark. So again, for a longer term play, I would look at some of these longer beaten down bases that have been out of favor because they are starting to turn up to the upside there. But as for swing trading and shorter term trading, I'm all about pretty much the momentum leaders in the market. A lot of them stem from the liquid momentum focus list as well as the TA page scans, and that's really where the shorter term swing trading opportunities have been helping out. Just making that income.
All right, so we're gonna bring in Trend Tracker. Now he doesn't he doesn't come on a whole lot, so I was able to pin him down and bring him on board today. Now, Trend Tracker, many of you probably are aware of his stock picks because they are longer term, and he is pretty much a bottom-up stock picker. Has a fundamental story, a little less in technicals, but definitely follows them. So I'm going to bring him in and get his idea of what 2020 may hold for some of his names. He was out in front of CrowdStrike last week, so why don't we start there, Craig? Why do you like CrowdStrike so much?
Well, it's the best cybersecurity company out there to own right now. I have a decent track record in the space. I still have some proof point, which is PFPT. They're the leading email security company for large enterprises. I think I'm in the $70 range. I've been in that one for a couple of years. I owned CBLK, Carbon Black, that got acquired by VMware. And they basically do the same kind of thing, endpoint detection, as CrowdStrike. But CrowdStrike is the clear leader in the space. You can take a look at their financial results, and they're quite staggering, growing triple digits, already free cash flow positive. The only concern is the valuation, and at 100, I was very cautious on the stock because it's hard to justify a 30-40 times revenue multiple. It was, I believe, trading at like 40 times forward sales in August. And that it just didn't make a ton of sense. It was, I think, the most highly valued in terms of market cap or enterprise value at one point. And when I suggested you could short that against Palo Alto, which is doing a lot more in revenue and profit, and had a slightly smaller market value. So that kind of pairs trade would have worked well. I started to get more positive as the stock kind of came back down towards 60 into the 50s, and they reported another fantastic quarter. Was it in December? But valuation is still sort of a concern. Now, at this juncture, obviously we had the Iran catalyst last week. So now all of a sudden, from a practical perspective, cybersecurity is top of mind for executives anyway, and it has been for years, and that's never really going to change. That's always going to be a top priority going forward, because you don't want your company to be in the headlines for getting breached and losing the trust of all your customers, obviously. So from that perspective, at a business level, that's never really going to change. But now this the potential for cyber warfare coming from Iran kind of just makes it more of a short-term momentum play here. But the setup into the next print is especially good. And that this is the case for a lot of these high growth, high multiple technology, mostly software stocks, where they're going to give guidance for next year, and estimates for next year are just way too low. So yeah, they should they should be able to beat manager near-term expectations, right? I mean, that's part of the game, is that they know they have to kind of blow it out in order to please investors and sustain their high valuations. But when you're also going to have them come out and say, well, next quarter is way above, and by the way, next year's going to be way above as well, I think the setup is finally there for CrowdStrike. So it was kind of stabilizing. I had kind of warmed up to it, and it's been stabilizing. And so I think on Friday morning, I had some time off, which was able to allow me to get some, disconnect a little bit and get fresh perspective. So when I came in, I just really liked CrowdStrike. So I started a position Friday morning, and maybe we'll look to add to it if we see any weakness here. Yeah.
Yeah, I just wanted to get quick updates on a couple of your other names. TTD, you're still involved with. AIMT, that's performing well. Are any of these names something that if anybody's come in late, is there still upside room to run? I know you're not looking to take any particular profits just yet, but would you be initiating any of these names?
It's hard to initiate a position at the highs. I mean,
so on hold. So more of a hold.
Yeah, I view them as like long-term core holdings.
So maybe buy the dip.
Yeah, and I've said that I think more recently. I did trim a little bit of TTD. At some point you're kind of being greedy if you don't take profits. But I took profits at, what was it, 250-ish, so now it's up another 30 points. It's within a couple points of the all-time high from August now, and if we're talking about the trade desk. So yeah, I mean, I said recently, this is the kind of stock that when it is out of favor, you want to buy the substantial pullbacks and hold it for the long term. That's my view on it. Even though, yeah, I mean, the mid-teens sales multiple isn't cheap, and I think maybe like 50 times EBITDA isn't cheap, but the market cap of 10 or 11 billion still allows for a lot of longer term gains, in my view. The advertising market is like approaching $1 trillion total market. They're kind of a independent. They stand to gain share over the long term. So I really like it long term. So with both CrowdStrike and a lot of these really high quality companies, they might not necessarily ever get cheap, but because you got to pay up for quality, and there's a premium for a reason. So you kind of have to rely more on the charts for your entries, because you're never going to get the most attractive cloud software business at a 5 times sales. It's possible TTD was trading at 5 times sales 2 years ago, but that was when it hadn't really garnered the respect on Wall Street yet, and now it has. CrowdStrike came out of the gate with all the respect in the world because it was growing so well, and because it's cybersecurity, which is like the hottest space there is. But that it got a little ahead of itself, and now it pulled back in, so it's attractive. Another one that I really like this year is Elastic, which, like CrowdStrike again, isn't necessarily cheap.
What's that ticker?
ESTC. I've been involved in this one, and that it's actually kind of finally starting to break out here after the gap down on earnings last month, and this is another one that's just a good long-term hold that should be able to grow 40% for many years. So again, the mid-teens sales multiple may not look that attractive, but a few years from now, it will. I can't really imagine too many scenarios where the stock isn't substantially higher, given that they will be doing, twice the revenue, still growing at a very healthy clip. It's an open source business model that, it's easy to kind of try and poke some holes. There's a couple different shifts going on that made this one, along with the high valuation, easy to kind of attack. And I can see why people would be skeptical of it, but big picture, the company's technology is very important, and I think the recent weakness, just like in CrowdStrike, is a buying opportunity for the long term.
All right, go ahead.
Sorry, and then another one where it's a very attractive setup here that I have a small position is Guardant Health, which is a precision oncology company. And
what's that ticker?
GH.
Oh, GH, got it.
It's another one that is extremely expensive in terms of revenue, but the setup into the next print, which is probably in early March, is very attractive because the estimates for next year are just way too low. And then one of my, CrowdStrike, Elastic, as I pointed out yesterday morning, are two of my favorites for 2020. The other one is more of a contrarian play in LYFT. Yes, I've been on this one from the beginning, and I have been wrong thus far, but it's now trading at like 2 times sales. The implications of having to classify full-time employees, I think, is sort of overblown, as most of their drivers aren't putting in those kind of hours anyway. And again, the estimates for next year, like the other ones, look too low. So I just think it's a attractive, good contrarian play here at this point.
All right. So CrowdStrike, ESTC, GH, and LYFT. Those would probably qualify as your favorite ideas. Fair?
Yeah. The CrowdStrike, Elastic, and LYFT for sure. Gardent is another one that I really like. I don't know if I'd put it in the same top pick category, but yes, I do like it here, and I'm long. So.
Okay, and are there any other names that you're beginning some research on that are really catching your attention that, you're kind of looking at a favorable scenario for 2020 that you don't necessarily have a position on yet, but maybe get out in front of some people?
That's a good question. There's, I mentioned a lot of different stocks.
Yeah, you do.
Nothing's really popping off the top of my head right now, but I will definitely include, any morning if I do see something that is intriguing. So.
Yeah, and that's subject to change because you're very, you get deep into the earnings and the story and the conference calls, so that could change, especially with earnings season coming up.
Yeah. One thing that I would like to add is, I tend to obsess a little bit over certain stocks. People notice that there's some stocks that I mention here and there, and some that I mention every week or almost every day. And I think it's kind of important to pick up on the fact that I do that for the stocks where there is a lot of conviction. 6 months or even a few months ago, I was all about TLRA and AIMT, and I still like those, but they've gone on a big run. So the risk reward, I think, in CrowdStrike, Elastic, and LYFT are now better. So the more I mention the stock, obviously, I would take a read off of that, I guess.
All right, and last up is Scalp Trader Damon Southward. Damon, looking at some of the names that you've been trading lately, it's almost as if you're doing some old school day trading from like 20 years ago. Seems to be what your MO has been of late. I saw that you just posted one in RAD. Now this was an options trade where you're picking up some weekly calls for 50 cents. You want to talk about that one, and then we can get into some of the other ideas?
Oh, sure. I've been trading Rite Aid a little bit on this recent volatility move from 8 to 24, I think, over about a week's time. Stocks had a meaningful pullback from 24 over just like the past week and a half. I started a spec swing long position earlier today, and as the name came down, I just wanted to look at the options to just see how expensive they were. And I was really surprised by just what I was able to pick up some weekly options for. So we're looking out to, I think they're January 24th, 1350 options for about 50 cents or so. I think they're trading up to about 60 cents right now. And so just looking for a bounce up to maybe the $14.50 to $16 area in the stock, which should at a minimum double the options. So little spec play, short-term spec play here. A lot of shorts involved in this name. I think it will continue to show some good volatility. Earlier today, actually just a few minutes ago, took some profits in XON, quick 15%. I think we were in that for about 3 days. Took some profits in about 15% on Overstock, which we got into yesterday. So there's some good volatility going on. On a swing basis, our Ping and Ruby positions are up more than 30%. I still love those. Like to see a little bit of pullback before adding to those positions, but as you know, with Ping, I've been very bullish on that one, and scaled in to get a full size position, and stock's really acting well. The Ruby's acting well. We actually still own some Teleria from the initial purchase, which is probably, I know it's probably up 130% by now at this point. They're the merger partner with Ruby, so it's tracking Ruby higher. The yield portfolio is just doing phenomenally. Everything's pretty much at all-time highs. Most of those names are energy related, so the push in energy prices has been supportive of those yield names, and we're talking yields of 9 to 10% on most of those. Had a great tax loss selling period, so got into a lot of energy names in December, and they really bottomed out. I think the group literally everything was hitting 52-week lows like around December 3rd or so, and just went vertical after that. So energy was good. We were able to take some profits. I think the final piece in CHAP, CHAP, for like 90%. So energy has been a good performer. In terms of stocks on the radar, I posted a comment on Intelsat earlier today. Ticker is I. That one looks interesting. I think that one still could potentially have some upside. Closed out the options position and the stock position in that, I think last week or the week before, for some decent gains, and now looking to try to start rebuilding the equity position. I like to get a pullback below the $7 area before doing that. And just waiting for earnings season. Last year was really good from a distressed and special situation standpoint, and the market's had a big run, so don't want to be too aggressive here. I like to see some things pull back. I like to see some stocks blow up on earnings and start to kind of dig around some of these names and look for some new setups.
All right, I know you're a guy who likes to do some homework, and this wouldn't be a 2020 thematic show if we didn't get some of your ideas and themes. If this was 2 years ago, you'd be talking all about cryptocurrencies. Is there anything that you find opportunistic that you're not currently involved in?
I'm more kind of a relative value type of trader, so I don't try to predict the future. I just kind of wait for the future to happen and then find the best opportunity to participate. I like to find the third tier names that are kind of under the radar, that people aren't maybe paying attention to. I think it's, I don't think I've really had much success. I don't think many people really have a lot of success predicting what's going to be the next big thing. But once those things start to emerge, it's usually pretty easy to kind of go through and find those second and third tier opportunities, such as, so Ping is a play on OKTA. What is the other one? Ruby is a play. The Ruby Teleria merger is a play on TTD. And so I got into those names just based on names that had already shown, major outperformance. And so it kind of creates a thirst and interest for the second and third tier names, because people don't necessarily want to pay up 20 times revenue to get into those first tier names. So you might be able to buy the second or third tier names at 2 or 3 times revenue and ride them up 2 to 4 times.
All right. I think that gives us a pretty good breakdown of where you guys stand as far as where your heads are at for trading opportunities and, for lack of a better term, themes. But is there anything that we might have left off that you guys are itching to talk about?
Yeah, I mean, I could give a list of some of the names that I'm looking at here in 2020, Jim. Just kind of rattle them off and the reasons why. We talked about TIP for the inflation standpoint, but a few other things that I'm watching kind of play out. Broadcom, AVGO, we played it a lot last year and had nice success in it, but still like this as a big winner this year as we start seeing a pickup in CapEx spending in the space. Talked about CapEx spending a couple weeks ago when I was looking at South Korea EWY as a top play. They got some easy comps to kind of plays into that comp story that Brett was talking about, where earnings should have a little bit more of a favorable outlook. I think the average earned EPS growth is expected to be in that 5 to 10% range, and CapEx spending, after being down this year because of a lot of the trade wars, is expected to pick up. And I think that South Korea, with their exports, could see a lot of that demand in electronic equipment. So I like the EWY. EWG for Germany is another name that I have on my list. I'm already involved in that, just as I think we see some of the rest of the world play catch up with the U.S. This is a new one I have out there, HASI. It's a their real estate investment trust. They basically finance alternative energy projects, and I think that will be a pretty big key theme as we get into a lot more of the ESG investing, which is environment, social, and government and governance aspects. As we see the millennials get a little bit more buying power, this becomes a bigger theme, and I think that the HASI plays into this and into the election campaign trail as well. EMD is another one, targeting emerging market debt. I think we could see a rise in yields in the emerging markets, and I think that could lead to a little bit of buying more in emerging market debt as they roll out of that negative interest rate area. Intel, INTC, is another name that is high on my list. I think this is kind of falling behind a lot of the other semiconductor names, but as we get a pickup in that CapEx spending, I think Intel could be a pretty big winner. And then two other names, GWPH and IIPR on the marijuana front, again during an election year. And then finally, Craig was talking about the cybersecurity plays. I'm in ZS here. I think that whole group will have a pretty strong year based around the potential Iranian response. So there are a few names that I got on my list for 2020.
All right, good stuff, Gavin.
Hey Jim, I just kind of wanted to add to that. Things are still a little quiet this week, but next week, earnings season picks up. Fourth quarter earnings season kicks off with the banks and a couple big industrials, but we are going to see the pre-announcement season, which for the Q4 is pretty substantial. I think we're going to see a lot of holiday sales reports next week from retailers, and in general, because there's a larger window that companies have to report Q4 results. The earnings season, as you know, Jim, is more stretched out, and we'll see a lot more pre-announcements in the coming weeks, and then a company may wait until like March to actually formally report their fourth quarter results. So. Things are going to pick up here over the next week with a lot of pre-announcements. I was just asked whether or not GH is a current position, and it is. I bought it at about 76 in November. And with respect to AIMT, I think the easiest money has been made. Now that it's back up into the mid-30s. The news of approval from the FDA could come anytime over the next few weeks. I believe in the drug, so the next leg higher could take some patience. It could take quarters or a lot of the year to really play out. If the blockbuster potential for Palforzia is real, then the stock is going much higher, but for now, I feel like the easy money has been made, which is why I took a partial profit. I think was it last week. So.
All right, appreciate that there, Trend Tracker. And I think that probably wraps things up. Brett, any last words?
No, I think that pretty much covers everything. Maybe one just point of general broad-based strategy. Everything that we talked about early on in this meeting sets up, and some of what the guys talked about later on in the meeting as well kind of conspire to set up the possibility that companies that gap down due to bad results in this coming earnings season could be really interesting, very quick turnarounds back to the upside, because this is playing toward a context that's really more about what's coming in Q2, in Q3. And we know we're coming out of a period where there was a valley. There were some tough times. And we know we've got some other possible risk-off catalysts that are in play right now. And it really could be an earnings season where you see a lot of interesting opportunities that are just, looks like a blow-up, comes ripping back.
Yeah, indeed. So, well, the good news, Scott will be all over those disruptive gaps, and he'll be able to let you know if they will be continuations on whichever way they do gap, or if they're gap reversal potential. So that's the good thing about having the trading team. We can decipher the good, the bad, and the ugly from these. So, gentlemen, I want to thank you all for participating in this, and I know it's going to be a lot of good stuff that people will want to hear again. So the good news for you all out there is that it should be recorded, and we'll have that up later this afternoon. So with that said, gentlemen, thank you so much for joining us today.